First, let's begin with the long bounce strategy. So for the long bounce, or the bounce long, whatever you want to call it, right? The first thing that we must see is that the price is on a confirmed uptrend. So how do we tell? By looking at the moving average fan sequence. So in other words, we want the 18 exponential moving average, 18 EMA, to be above the 50 EMA, which is then above the 100 EMA, which is then above the 200 EMA, because this tells us that the price is on a very clear short-term uptrend, medium-term uptrend, and long-term uptrend. So all trends are up. Next, we want to see the price bouncing off one of the key moving averages, right? The 50, the 100, or the 200 moving average. Now, the price can bounce off the 18 moving average, but under special circumstances, which we'll be talking about later. Now, the important thing is that when the price bounces off one of the moving averages, it must do so with the specific two-candle or single candle reversal pattern with a confirmation candle, which we've learned earlier. Okay, at that point when it bounces at the reversal candle, we want to see that stochastics is oversold. All right, ideally below 30. Right, usually oversold is below 20, but I'll be less strict in this case and say below 30. Okay. Or stochastics must recently be below 30 and just cross bullish from oversold conditions at the reversal candle. So if you take a look at, let me just zoom in, this is the stochastics, right? And you can see that the percentage K is the brown line. The percentage D is the blue line. Now, when the brown line crosses above the blue line, stochastics has just crossed bullish. Right, or rather the percentage K cross above the percentage D. Now when percentage K crosses below percentage D, like in this case, stochastics has just crossed bearish from overbought conditions. Okay. Next, I want to make sure that MACD, okay, now in this particular strategy, MACD will not be using the 12-26-9, we'll be using the 50-109 setting. Okay, so we want to ensure that MACD is bullish during the reversal candle bounce. Now, if MACD is bearish, I'll still take the trade, but it should not have crossed bearish recently. Now, how recent is recent? Okay, it should not have crossed bearish less than 5 candles ago. So if it crossed bearish like 6 or 7 candles ago and it's been bearish for quite a while, that's fine. But if it just crossed bearish, I'll not take that trade. Okay, and I'll give you a lot of examples as we go along. Okay. So these are the specific entry criteria for a long trade. So once we see those criteria, right, so if you look at this chart, let's take a look, right? So we can see that the 18 EMA, which is the blue dotted line, is above the 50 EMA, which is above the 100 EMA, which is above the 200 EMA. So we've got a very nice uptrend moving average sequence. Okay, so that's the first criteria. Next, price must be bouncing off one of the moving averages. In this case, price is bouncing off the 50 moving average, as you can see, the blue line, okay? It must be bouncing off with a 2-candle reversal pattern. And you can see over here, we have that 2-candle reversal pattern, which is pattern 3, which is the trade through pattern, right? If you recall from the previous lesson, that's the trade through pattern, followed by a confirmation candle over here, all right? Now, at that reversal candle, stochastics should be oversold below 30. All right, so you can see that at this reversal candle, all the way down, stochastics was below 30 recently and just crossed bullish, where the brown line, percentage K, crossed above the blue line, percentage D. Now, depending on the charting software you use, the colors may be different. All right, so you can set the colors up, but just understand percentage K above percentage D, all right? At the same time, MACD, which is over here, MACD 50-109 setting is bullish, all right? Because the MACD line, in this case is black, is above the signal line, which is red. So that meets all the criteria. So once you meet all the criteria, you can place your entry order and your stop loss and your target price order. So let's take a look how to do that. So for our entry, we'll place a buy stop limit order a few cents above the confirmation candle. Okay, So for example, in this case, you can see that this is the 2 candle reversal pattern over here, all right? And it is bouncing off one of the moving averages. And right after that reversal candle, we have got our confirmation candle, which we have learned earlier, right? That makes a higher low from the reversal candle and closes above the high of the reversal candle. So that's our confirmation candle. Now, of course, the confirmation candle could have an upper or lower shadow as well. No worries about that, okay? But it's going to close above the high of the reversal candle. Now, so we place our entry, which is a buy stop limit order, a few cents above the confirmation candle, right? So wherever is the high of the confirmation candle, our entry will be a few cents above that high. So again, what's a few cents? Well, similar to the impulse pullback strategy you've learned, rule of thumb would be if the stop price is below $5, we'll use a 1 cent. So in other words, the buy stop order will be 1 cent above the high of the confirmation candle. 1 cent above the high, okay? If the stop price is between $5 to $10, we can use 2 cents. Again, it's a rule of thumb, all right? If the stop price is between $10 to $50, we can use 3 cents. If it's between $50 to $100, then we use 5 cents. And anything above $100, we can just use 10 cents. Okay, so this is just a rule of thumb. Yeah, great. So as you place the entry order, you also want to place a stop loss order, right? So this is a sell stop order that once again we place a few cents below the confirmation candle. Okay, or we could place a stop loss below the reversal candle. Okay, now, so I can either place a stop loss below the confirmation candle or below the reversal candle, or anywhere in between. So you may be thinking, okay, so where do I place it? Well, it all depends, right? If the confirmation candle happens to be pretty big, right? It's a big confirmation candle, I'll place my stop loss just below it, okay? Why? Because if the confirmation candle is big by itself and I place the stop loss below the reversal candle, what's going to happen? My 1 hour distance would be from the entry price to the stop loss price. My 1 hour may be very big, right? The risk per share is very big. Remember, if your 1 hour is very big, it's very difficult to hit 2 hour or 2.5 hour, okay? So that is why if the confirmation candle is rather big, I'll put my stop loss right below the confirmation candle. So the 1 hour is tighter, I can hit 2.5 hour faster, okay? Now, but if the confirmation candle happens to be a smaller confirmation candle, then I could afford to put the stop loss below the reversal candle. And if I do that, my 1 hour distance would not be that big since the confirmation candle is not that big, okay? Now, some of you may be asking, okay, what is big, what is small, right? I'll show you a lot of charts, a lot of examples. Usually I visually estimate it, but if you like to have a specific number, I'll use a number called ATR. All right, what is ATR? ATR stands for average true range, okay? Average true range tells you the average range of the candles of this particular stock. Now remember that range, what does range mean? Okay, the range of the candle is from the top of the shadow to the bottom of the shadow. That's the range of the candle. Now of course, different candles have different ranges, right? Now, what is the average range of the candle of this particular stock? Okay, it's different all the time, okay? So I'll show you how you can calculate the average true range. Now, for example, if you take a stock like McDonald's, okay, you may discover that the average true range, the ATR of McDonald's is, for example, $1. What does it mean? It means to say on average, McDonald's candles are $1 in range. That's the average daily volatility of McDonald's share price. Now, why is this important? Because usually when I place my stop loss, I want to ensure that the 1 hour distance, remember what is 1 hour? 1 hour is the distance from the entry price to the stop loss price, which is the risk per share. Okay, I'll make sure that the 1R is ideally more than 1 ATR, but less than 1.5 ATR. Why is that so? Because 1 ATR represents the average daily movement of the stock. Okay, so if McDonald's ATR is $1, it means McDonald's moves by an average of $1 a day. Okay, now if my stop loss distance is less than 1 ATR, it may get hit pretty easily because if you know McDonald's moves by $1 a day and the stop loss is less than $1 away, it's going to get hit pretty easily, right? But at the same time, if your stop loss is much bigger than 1 ATR, it'll take a lot of effort for the price to move, right? Because the average range is $1. Okay, so this is a more specific number I can give you, where more than 1.5 ATR would be considered too big of a 1-hour distance. And in that case, I'll tighten my stop loss to be less than 1.5 ATR. And again, I'm going to show you a lot of chart examples so you're a lot clearer with that in a while. Okay. Great. So once I've determined my 1-hour distance, okay, so again, your 1-hour could be here or it could be here, yeah. Then I'll set my target price, which is a sell limit order, 2.5R above my entry price. So that's how I place my orders for the long bounce entry. Okay, so let me explain in greater detail using these charts, right? So this was a trade I took sometime in April. Is on RGEN, and you can see that the price moved up and it came down, retraced, and it's bouncing off the 50 moving average. Okay, and this is what we call a single candle reversal pattern because that is a bullish pin bar, right, followed by a confirmation candle that makes a higher low, okay, and closes above the high of this candle, right? Great. So in this case, where would I put my entry price? I'll put it a few cents above the high of this candle, right? Great. So now notice as I click this, there's a box that appears on the left. Can you see that box? Well, when I click, it will appear. There, right? Great. Now, if you look at the box, it says high, low, right? So that tells me the high of the candle and the low of the candle, which I need to calculate where to place my buy order. So again, I'm going to click on that, and can you see high 34.35? High 34.35, right? Great. So the high of this candle is 34.35. Where do I put my entry? Right, 3 cents above the high. So 34.35 plus 3 cents, 34.30, 38. Right. So I'm going to put my buy order. Just going to note it here at 35. Sorry, not 35. 34.38. 34.38. Now I can't get the exact. Can't move it to the exact amount with this line, but let's just leave it at 34.39, right? But it should be 34.38, okay? Let me just write it down here as well, okay? So I'm gonna, my entry price, let me write it down. Entry price would be a buy stop limit order. Okay, and the stop price would be 34.38. Okay, which means the next day, if the price goes to 34.38, it would trigger the order and buy at the market price. But I must place a limit because I do not want to buy beyond a certain price. So usually I put a limit price, again, 3 cents above the stop price, which would be 34.41. Okay, so let me repeat that, right? So I'll place my stop price 3 cents above the high of the candle and the limit price 3 cents above the stop price. Okay, great. So that's my entry price here. Now, where do I place my stop loss? Like I mentioned, I can either place my stop loss below the low of this candle, which is somewhere here. Let me just draw it. Okay, either at 30, let's see what's the low. The low is 33.40. So 3 cents below that will be 33.37. 33.37. There we go. Okay. So I can either put my stop loss at 33.37, or I could put my stop loss below the reversal candle, which is below this candle. Okay, and the low there will be 32.73. So I will put my stop loss at 32.70. All right. So would you rather put your stop loss here or here? Now, many traders would think, hey, isn't it better if my stop loss is further away? Because if it's further away, you can't get hit that easily, right? I give myself more room. Well, that's true, but remember that the further away your stop loss is, the bigger is your 1R. Okay, your risk per share is bigger. And if 1R is bigger, it's going to be harder to hit 2R or 2.5R. So we want the stop loss to be as tight as possible, but not too tight that it could get hit really easily if the price retraces slightly. Does it make sense? Okay. So now I can tell you that from experience, I would in this case place my stop loss at 33.37, right below the confirmation candle. Okay, because this would be a nice 1R distance. This would be 1R. If I were to put my stop loss here, then my 1R would be too big. Okay, too big. Now again, how would you know if it's too big if you don't have the experience? Well, again, I use ATR. So let me show you what's ATR. So whatever charting software you're using, you can add an indicator known as ATR, average true range. Can you see that? That's the one. So you click on that and it appears over here, ATR. Now this line you see here, this line is the average true range. This tells you what is the average daily range of this stock, or the average volatility. So what I like to do is, now you can see that it changes all the time. So which figure do you take, right? So I like to scroll back to the last 3 months. Okay, so that's about 1 month, 2 months, 3 months, right? Roughly, okay? And what I do is I take, now if you look at the ATR, the highest ATR is somewhere here, so 122. The lowest is 68 cents. So I just roughly take the center or the mean of the chart, which will be somewhere, well, I'm just estimating. You just need to estimate it roughly, right? Be somewhere, I guess about, well, say here 95 cents. Okay? So what this means is that this stock RGN moves an average of 95 cents per day. That's the average range of this stock, the ATR, 95 cents. So what it means is that when I place my stop loss, all right, ideally it should be more than 95 cents. Okay, more than 95 cents, but not more than, okay, let me just write down. Okay, so 1 ATR in this case is 95 cents, right? For this particular stock, okay? So ideally your stop loss should be about 1 ATR, right? Now, but like I said, your stop loss should not be more than 1.5 ATR, because if it is too big. So what's 1.5 times 0.9? Let me just take my calculator. 0.9. It's about $1.42. So your 1R should not be more than 142. Okay. So if I were to place my stop loss at 32.70, you can see that from 34.38 to 32.70, it is bigger than 142. So it's too big, right? So the ideal stop loss should be 33.37, because if you do that, what's my stop loss distance? 34.39 minus 33.37. That'll be $1.02. Okay? So in other words, if I place my stop loss at, again, my stop loss is a sell stop order, right? And I'll place it at 33.37. Okay? There you go. So that's my entry price, that's my stop loss price. Okay? So what is my 1 hour distance? My 1 hour distance will be from here to here. Right? That's my 1 hour distance. And my 1 hour would be, again, I calculate 102. So in this case, 1R is 102, which is slightly more than 1 ATR. That's perfect. Okay, so if 1R is 102, what is 2.5R? Again, grab your calculator, take 102 times 2.5, that's 255. So this tells me that I need to place my target price at $2.55 above my entry price. So 34.38 plus 255, my target price, or my TP, target price, which is a sell limit order. Again, you got to be familiar with all these order types I'm using. If you're not, please review the professional trading course level 1 under placing orders, right? So my sell limit order will be 36.93. Got it? All right, so I hope that's clear enough. Yeah. So 36.93 is my target price. Let's see if I'm able to hit it. Okay, so I'm going to erase everything. Okay, so let's see if I enter this trade well. I did, because I did take the trade a couple of, all right, so there we go. Okay, so you can see the next day the price goes above the high of the candle. It triggers my buy order. It goes all the way up, okay, and it hits my, it then retraces a bit and then goes up and hits 36.93, which is somewhere around here, 36.93, that's right. So this is my place where I take profits. All right, so that's exactly how I would enter a entry for a long bounce setup. All right, so let's take a look at a couple more examples of the bounce setup, and you can see the price retracing, in this case, to the 50 moving average, and we've got our 2 candle reversal pattern over there. Okay, that's a reversal candle, and does it meet all the criteria? Yes, it does, right? The 18 EMA is above the 50, 50 is above the 100, and the 100 above the 200. So we have got that perfect sequence of moving averages. MACD, as you can see, is bullish, right? The MACD line is above the signal line, and at the reversal candle, stochastics is below 30, right? So price is oversold, MACD shows bullish momentum, price finding support at the 50 moving average. So right after that, we have got our confirmation candle, okay? That makes a higher low and closes above the high of the candle. So that's a confirmation candle, okay? So again, we place our buy stop limit order, which is our entry price, a few cents above the high of this candle. So it's a $60 stop. I'll place it about 5 cents above the high of the candle. And I'll place my stop loss, okay, below the low of this reversal candle, which would be, again, 5 cents, right, 3 cents, right? So that's my sell stop order. Again, I could have placed my stop loss below the confirmation candle or below this reversal candle. Now, since both of their lows are very close, I might as well put it below the reversal candle because it doesn't make much of a difference anyway. Yeah. Great. So that's my 1 hour distance. So I have to measure 2.5 hour, and that would be my sell limit order. That's my target price. So the next day the price goes up above the high of this candle. My buy order gets triggered, so I'm in the trade, and I hit my target price somewhere around there. Okay. This is SNPS. Okay, so again, price retraces to the 50 moving average, and you can see that this is a 2 candle reversal pattern, and also a single candle reversal pattern because this is a bullish pin bar. All right. So again, let's take a look. All the moving averages are in sequence. The 18 EMA is above the 50 moving average. Okay, by the way, if the 18 moving average, the blue dotted line, is below the 50 moving average, it is not a valid trade, right? Again, you got to have that sequence of moving averages, 18 above 50, 50 above 100, so on and so forth, okay? So we have a confirmation candle, has a higher low, then the reversal candle closes above the high of the reversal candle. So now let's check out the other indicators. Our stochastics, is it oversold? Is it below 30? Yes, it's below 30. All right, and it just crossed bullish, in fact. Now, MACD, is it bullish? No, it's not. It's bearish, right? MACD is bearish because the MACD line is below the red signal line. Now, recall the entry rules. For long bounce entries, the MACD must be bullish, all right? But if it is bearish, I would take the trade if it crossed bearish more than 5 candles ago. Recall that, right? But if it just crossed bearish, I won't take the trade. Now, when did it cross bearish? It crossed bearish somewhere around here on the 28th of May, right? So how many days has it been? 1, 2, 3, 4, 5, 6 days. It's been 6 days since it crossed bearish. More than 5 candles ago, that's fine. I can take the trade, all right? Hope you understand that. So I place my buy stop limit order, again a few cents above the high of this candle, 3 cents above the high of this candle, and again I could put my stop loss below this confirmation candle or below the swing low candle, or anywhere in between is fine as well, as long as it is more than 1 ATR and less than 1.5 ATR, right? So in this case, I place my stop loss somewhere here in between the low of this and the low of that. That's my 1 hour distance, okay? Again, I measure 2.5 hour. That's my target price. My sell limit order is somewhere in 49, 48, 70, right? So the next day, the price goes up, retraces, hits my buy order. I'm in the trade and I hit my target price in about 6 days, okay? Another example, KMX. So price retraces once again to the 50 moving average. We have got a bullish pin bar. So that's a single candle reversal. It is also a 2 candle reversal pattern at the same time. Right after the reversal candle, I get my confirmation candle, right? Which is bullish, makes a higher low, closes above the high of this candle, okay? Now, at the reversal candle, let's check our stochastics. Is our stochastics oversold? Yes, it's below 30. Again, it must be below 30 at the reversal candle. MACD is again bearish, right? Because the black line is below the red signal line, so it is bearish. Now, again, it can be bearish, but only if it's more than 5 candles ago. So it turned bearish somewhere here on the 20th of January, right? So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days ago, it turned bearish. So that's more than 5 candles, that's fine, all right? We can take a trade. So we place our buy stop limit order, again above the high of this candle. And in this case, I'll put my stop loss below the low of the confirmation candle. Why? Because if I put my stop loss here, that's going to be too big. My 1 hour is too big, definitely more than 1.5 ATR, okay? So I'm going to put it there. So the next day, the price goes above the high, triggers my buy order, okay? So I'm in the trade, hitting my target price. So let's now move on to the entry rules for taking short trades. So for the bounce short entry, these are the specific criteria that must be met. Well, first, we want to see a confirmed downtrend. So in this case, the 18 EMA, right, the blue dotted line is below the 50 moving average, below the 100 moving average, and below the 200 moving average. So we want to see that sequence of a downtrending moving average fan, okay? So that's the first criteria. Second criteria, we want the price to be bouncing off one of the key moving averages, the 50, the 100, or the 200 moving average with a 2 candle reversal pattern or a single candle reversal pattern with a confirmation, yeah? So in this case, you can see that the price is rallying, right? And again, hitting that 50 moving average, bouncing off, right? With a single candle reversal pattern. And this also is a 2 candle reversal pattern at the same time, followed by a confirmation candle. So the next criteria would be that at the point of the bounce, which is here, we want the stochastics to be overbought above 70. All right, so that is important. And we want MACD 50, 109 to be bearish. All right, so again, if we're going short, we want MACD to be bearish, where the black MACD line is below the red signal line. Okay, now if MACD is bullish, all right, I will take the short trade as well, as long as it did not turn bullish recently. So again, the same rule applies. The MACD should not have crossed bullish less than 5 candles ago. So if it's more than 5 candles, 6, 7 candles ago, cross bullish, that's fine, but not recently cross bearish, right? All right, so once you've got all these criteria, you can place your entry, all right? So the entry would be a sell stop limit order. Again, a few cents below the confirmation candle, right? Based on what you've learned just now, 1 cent, 2 cent, 3 cent, depending on the price of the stock. So in this case, you can see this is a 2 candle reversal pattern, okay? That's bouncing off the moving average, followed by a confirmation candle that makes a lower high and closes below the low of the reversal candle, right? So once you see that pattern, again, the confirmation candle can have an upper or lower shadow, right? Doesn't matter, okay? So our entry price, which is over here, would be a few cents below the low of the confirmation candle, anticipating that the price would continue going down. We place our entry price over there. Where do we place our stop loss? So again, for the stop loss, it is a buy stop order, right? Because when you're selling short, you need to buy to cover your position. So if it goes up, you need to buy back at a loss to cover your loss, okay? So the buy stop order would be, again, a few cents above the confirmation candle, okay? So we can put the stop loss a few cents above the confirmation candle. That would be stop loss 1, okay? Or the stop loss can be placed a few cents above the reversal candle. This would be stop loss 2. So we can either place a stop loss here or the stop loss here or anywhere in between, right? So again, where do we place it? It depends. If the confirmation candle itself is pretty big, I'll place the stop loss right above it. If the confirmation candle is small, I could afford to place the stop loss above that swing high candle and still have the 1 hour not too big. So again, look at your ATR, your average true range, okay? So ideally, your 1 hour distance should be more than 1 ATR, but not more than 1.5 ATR. All right, so that is the 1 hour distance. Once you know your 1 hour distance, you can set your target price by placing a buy limit order 2.5 hour lower than the entry price. So the take profit will be somewhere over here, okay, which would be 2.5 hour below the entry price. There we go. All right, so let's take a look at a few examples. LPT, all right, so it's on a clear downtrend. Take a look, 18 EMA, blue dotted line below the 50 moving average, below the 100 and below the 200. So you've got that downtrend sequence going, okay? The price rallies up and bounces off the 50 moving average with a single candle reversal. That's a bearish pin bar, okay? Now, it is also a 2 candle reversal pattern at the same time. So at the reversal candle, let's check it out. Is our stochastics overbought? Yes, it is above 70. Oops. All right, so it's overbought, okay? And MACD, right, is bearish, right? The black MACD line is below the signal line. It is bearish. So these two indicators confirm that it is overbought. It's having bearish momentum. It likely will go down. So right after the reversal candle, we have our confirmation candle that makes a higher low and closes below the low of that candle. So that's our confirmation candle. All right, great. So we'll place our sell stop limit order 3 cents below the low of this candle. In this case, it's $30 stock. We put it 3 cents below the candle. Now, in the case of doing a short trade, the stop price is 3 cents below the low of this candle. and the limit price would be 3 cents below the stop price. Okay, so when you're going short, the limit price is always less than the stop price. It's always lower than the stop price. When you went long, the limit price is above the stop price. Just take note of that. Okay, and our buy stop order, which is a stop loss, we can place it 3 cents above the high of this confirmation candle, since it is a pretty big confirmation candle. So that's 1R. That's my 1R distance. Measure 2.5R, and that's my buy limit order, which is my target price somewhere around here. So the next day, the price goes below the low of this candle, triggers the sell order, and we take the trade all the way down. Okay. Next on the list, we have got JC Penny. Again, ensure it's a clear downtrend, 18 EMA, below the 50, below the 100, below the 200. All right, price rallies, and you see that reversal candle, which is a bearish pin bar, single candle reversal pattern. So at this point, note that stochastics is overbought above 70. Okay, MACD is bearish, right? MACD line below signal line, so that's overbought, bearish momentum. Okay, so right after the reversal candle, we have our confirmation candle that makes a lower high, closes below the low. There we go. That's a confirmation candle. So we place our sell stop limit order. In this case, it's just a $9 stop. So we can put a sell limit order 2 cents below this candle, and our buy stop order 2 cents above the reversal candle, because between the high of the reversal candle and the confirmation candle is pretty close, so I might as well put it there. All right, so that's why 1R, measure 2.5R, that is my target price, which is my buy limit order. Okay, so the next day the price, now what happens the next day? The next day we have got an inside bar, right? So the next day it doesn't trigger the order, right? So if it doesn't trigger the order, we can leave it there until it triggers, as long as that moving average resistance is not breached. The moment it is breached, we cancel the order. Or the moment the 18 EMA crosses above the 50, we cancel the order. So on this day, the order was not triggered, so we leave the order there. The next day, it is triggered, goes below the low of this candle, triggers the order, and takes it all the way down. All right. All right, let's look at DAN right now. So DAN, again, clear downtrend pattern, price rallies to the 50 moving average. And this is a 2-candle reversal pattern. Take note that this is not a single candle reversal, because it is not a bearish pin bar. A bearish pin bar must have a long upper shadow. It does not. It is a doji. Okay, so you have to follow the rules of a 2-candle reversal pattern. Again, do revise those rules in part 1 of this lesson. Yeah. So that's a reversal candle. Stochastics is overbought above 70 at the reversal candle, and you can see that MACD is bullish, right? When we're shorting, MACD should be bearish, but it's bullish, but it crossed bullish here. Okay, so 1, 2, 3, 4, 5, exactly 5 candles ago. Okay, barely passed, we'll take it. Confirmation candle, lower high, closes below the low, shows us that price is reversing. All right, so we place our sell stop limit order, in this case 3 cents below the low of this candle. Stop loss, again above that confirmation candle or above the swing high candle. That's my 1-hour distance. Target price 2.5R. Next day the price goes down, triggers my order, and I take the trade all the way down. All right, so pretty straightforward once you get a hang of it. Yeah.